If you feel there's a catch-up move baked in, it's because you're not looking at what really is carving out that price chart.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pains.
That's going to be bonkers.
Okay, guys, it's Kevin Wadsworth and Patrick Karim from Northstar Badcharts.com, and welcome to another Talking Trades. Today we're talking about gold, and we're talking about the precious metals miners, gold miners as well. It's a question of trying to bust some myths here. We're looking at the relative performance of gold and precious metal miners over time. Pat, what have you got to say on the subject?
Yes, Kevin. Look, I don't know what's up with the miners, but even back in the days there when we started covering the precious metals back in 2018, when we saw that gold was breaking out in the Australian dollar and Canadian dollar, and we saw all this happening, of course, the first thing you hear is, okay, well, gold's breaking out. What am I going to do? I'm going to, the miners are leveraged play on the metals, right? We always hear that. But then, of course, yes, the miners off exact lows, and then they rush to a peak. They're going to do great gains. Why? In a percentage way, they're going to do great gains because they've been destroyed so much. When something starts off pennies, any type of move is going to look in percentage wise huge, right? And that's when people say, oh, I have a 10 bagger, I have a 20 bagger, etc. But you're starting from a low, which you only know it's a low in hindsight, right? It's that because a lot of people thought they got lows in a bear market, right? And everybody who's done this, they realize that, oh, this is the low, it has to go up. Oh, no, it goes up, bear market rally, it goes even lower. Oh, this is the low, it goes up, bear market rally. And then you're doing lower highs, lower lows, you're still in a downtrend. So you got to wait for the evidence to show you that something's materially, objectively has changed, right? You need higher highs, higher lows. So that's the first step for these miners. And you got to, I'm not going to even talk about risk and money management, but in real life, professional traders, they won't have it. They never measure in percentage moves off flows, right? It's about where's your entry, where's your sell stop, where's your profit target, what's the ratio of your loss versus your reward. And then after that, positioning size correctly. It's not about, oh, it did a 10 bagger, right? That's not how professional chart traders do. But I'll show you one chart, Kevin, to kill that myth about the miners. This is the ASA chart. ASA is a precious metals. It's a gold and silver miner index, and it's the oldest still active precious metals gold and silver miners fund, and it dates back to 1968. And this is important because we get two bull eras in gold. We get the 1970s bull era in gold, and we get the 2000s bull era in gold, where gold always did new highs. So we get that evidence. We're not looking short term, where people are putting out charts saying, look, there's a discrepancy between gold price and the miners. The miners have to catch up. No, guys, they don't have to catch up to anything. If you feel there's a catch-up move baked in, it's because you're not looking at what really is carving out that price chart. But before I digress too much, this is the gold and silver miners priced in gold. So what's the performance of these miners in real terms priced in gold? And guys, this is objective. Down and sideways, down and sideways. Since 1968, 1974, bear market rally, 1984, bear market rally, lower highs, like I was explaining to you before, sideways, broke down. Is anybody here trying to front run this? Oh, look, there's a clear breakout line. I'm going to front run that, and it has to break up, right? Oh, this is cheap. This is cheap. This is cheap. Well, look what happened. It got cheaper. It broke down. Bear market rally, right? 2007 peak. I'm saying bear market rally because you're not overcoming previous highs, right? 84 did not overcome 74, 74 did not overcome 68, 2007 did not overcome 84. What happens? People front running this, oh, it's going to the moon. But guess what? I could have drawn here a beautiful breakout line. The opposite happened, broke down, went even lower. Gold, guys, was from 2008 to 2013 or 11, 12, gold was going bonkers. Look what the gold and silver miners did. They severely underperformed gold on that way down, all the way here to the bottom. And while, look, people are calling triple bottoms for gold and silver pricing gold. But until you have a trend reversal with an important trend line break to the upside, that thing could just be a continuation pattern that you've had here, you've had here, you've had here. You can't front run these possible moves. This is the truth, Kevin. Since 1968, the miners have lost 95% versus gold. Betting against that, it means you're hoping for a statistically different outcome. You're hoping to catch one of these cyclical bear market rallies within this, I don't even know, it's huge, like it's more than secular, it's this historical downtrend for the miners pricing gold. So even if gold and silver miners, they do a 10x and they do a whole bunch of stuff and they keep going up, they're still underperforming gold. So this bears the question, why hold them instead of gold, right? This is should be a big wake-up call. Look, of course, guys, this is an index. There are miners, I could count them probably on one hand, maybe two hands, miners that can hold their ground against gold, or there's maybe less than 5 that are actually outperforming gold. I'm not even sure. So it's just a loser's playing field, right? It's just always trying to go against the odds, always trying to be a contrarian. But being a contrarian and trying to pick bottoms is just a recipe for disaster. At least wait, guys, for some evidence here. Here's like a wake-up line I could have drawn. At least wait for something to show you that there's something happening positive where you have more chances of having a sustained uptrend. But it's just not looking good for gold and silver miners as a whole, guys. Priced in gold, there's practically no reason to hold them.
That's amazing stuff there, Pat. And one thing I just wanted to clarify as well for people watching this, this particular mining index, is it the same as GDX, for example, which people might be more familiar with? So this ASA index that perhaps people aren't so familiar with, is it very similar to GDX if we're looking at miners in the GDX?
Okay, so here, guys, look, this to answer Kevin's question about what's the ASA chart, how does it track JDX and all that stuff? Look, here's the ASA since 1968. I'm going to overlay JDX, new price scale. I'll put it on log scale. And it's practically the same chart, guys. And this shows you that, look at that, it's the same chart. Capital flows are carving out this. So if you want to know how the JDX would have looked like prior to its inception, it's fine. Just look at the ASA chart, because there's a high likelihood that the JDX would have looked at exactly like the ASA chart if you would have extrapolate its start date or inferred its start date from like 1968. So there's no mystery there, guys. ASA chart, it's a JDX chart, but better, because I got data covering the 1970s bull era. I got data covering the 2000s bull era, and more evidence, then the more likelihood that your assessment is more accurate.
Fantastic stuff. Thanks, Pat. And thanks for joining us for this episode of Talking Trades. Don't forget to follow us for more content.